Salesforce, one of the top performing Dow components right now on the back of new activist stakes in the company. Elliott Management now has taken a multi-billion-dollar position in the company. And our own David Faber reporting Jeff Ubben's Inclusive Capital has also gotten involved. The stock's up about 17% so far this year, but still more than 33% off its highs. Let's bring in Cowen analyst Derrick Wood. He downgraded Salesforce Friday on growth and restructuring worries. Though I don't know, are you rethinking that? Isn't all this activist involvement bullish?
Well, I think we'll have to see what the plan is. There's no detail. If we have an analogy with when Elliott got involved in SAP, which was in 2019, they had actually been talking for a couple of months before there was an announcement that they had taken a big stake. And what happened was that they backed the SAP plan at the beginning of the year in terms of driving 500 bips of margin expansion. So we do have to ask the restructuring announcement that we got earlier this month, the 10% headcount reduction, the real estate moves that they're going to do. Is this all kind of part of the plan already that that maybe Elliott wanted to get the ball rolling on, or is there going to be some other bigger cuts and more aggressive margin expansion to target? And that we don't know at this point. We do know that Starboard, when they got involved a couple months ago, they did lay out a target where they thought the 25% operating margin goal for fiscal 26 was maybe not aggressive enough, and they could see a pathway to move that to maybe 28 to over 30% margin. So maybe that's the upside, but the macro picture here definitely looks a lot different than it did a few months ago. And so the revenue assumptions may have to change with this whole in terms of driving profit growth.
But everything you just said and everything that the activists want, isn't it everything that Mark Benioff is also already prioritizing? He's talked a lot about that operating profit, boosting margins, making cuts on the staff and on the real estate. And this is his playbook already, isn't it?
Right, and this is something investors have been asking for a long time. Move away from making acquisitions, focus on organic growth, on improving cost efficiencies, and for a business of this scale, driving operating margins closer to your long-term targets, which are 30% plus. And there's some real action being taken now at this point. But one question we had in the downgrade is the sales efficiency analysis we made last year. It just looks like sales costs went up a lot, and there may need to be a long way to go before we get the cost structure aligned with where it should be. And there may need to be multiple iterations of cuts from here, and whether we see more headcount reductions in the new year, I think is still a question. And then how disruptive that will be to the top line is also a question.
Sure, but they also hired a lot during the pandemic and grew a lot during the pandemic, just to put it in perspective. So what is the play here? Do you think that, I mean, I assume a lot of these companies just want board seats, right? That's usually how some of these activists listed, probably all of them, want a board seat. Is that a realistic scenario? And would that help matters?
That's certainly a possibility. I think all the terms for the board members are 1 year. So there could be a proxy fight. Other scenarios could be to push for some business unit sales. A couple of the underperforming assets that were acquired recently have been MuleSoft and Tableau. And I guess you've got to wonder what the margin structure looks like on those businesses. And maybe you could sell off those units and drive up operating margins for the total company. You could look at trying to do a more aggressive buyback. They've already announced their first ever buyback, $10 billion. They bought back $1.7 billion in the first quarter of the announcement, which was last quarter. And it's not like they have a lot of cash on the balance sheet. There's $13 billion in cash, $10 billion in debt. So there's not a lot of capital to kind of push back to shareholders via a buyback unless they took on a significant amount of debt to do that. But those are some of the scenarios to think about in addition to just pushing for more margin expansion.
Yeah, I think succession planning also is going to be a question that they'll ask. Derrick, appreciate you coming on to talk about it. I know you just did that recent downgrade from Cowen. 160 on Salesforce.
Thanks for having me.
I'll show you what's happening.